Hey everyone, it's Mark Sabrin from Winnipeg Financial Planning. Today I want to talk to you about MTAR accounts. So in Canada, there's only 3 places you can invest tax-free. Your primary residence, so let's say you bought a house 30 years ago for $100,000 and today it's worth $500,000, all of that growth is tax-free to you. The second being a tax-free savings account. So let's say your TFSA is worth $100,000 today and it grows to $200,000 in the next 10 years. All of that growth is also tax-free to you. Now the third place you can invest tax-free, and a lot of Canadians don't know about this, is through an MTAR account. So before using this strategy, you need to have a proper retirement plan. And I'm going to show you why that's important. So let's say that this is your retirement portfolio. And from the age of 60 to 65, you're going to spend that chunk. And then from 65 to 70, this piece of your portfolio, and then to 75, 80, 85, and let's say, just to be safe, that you live all the way to age 100. So for this individual, they have this entire slice of their portfolio that they're never going to have to spend. So if that money is in an RSP or a RIF, you might lose up to 50% of that to taxes when you pass away. And if you have that money in a non-registered account, every year you're paying tax on any interest or dividends or capital gains that you incur within that account. So let's say for this individual, they have $1 million in this last sliver of their portfolio that they're never going to spend. All right, so that number can be anything. So it could be 100,000, it could be 500,000, it could be 5 million. This strategy is still going to work. So how do we get this $1 million into an account where it's growing tax-free instead of being subject to tax, like I was just mentioning? So let's say that you're 60 years old. So one place that you can invest tax-free is within an insurance policy, so a life insurance policy. Let's say that that policy costs $20,000 per year. All right, so the benefit of the insurance policy is that the eventual benefit will get paid out tax-free to your beneficiaries. Now, because you have a life insurance policy, you can also get an MTAR account. All right, so this is a separate account. It's attached to your life insurance policy, and what it allows you to do is to make deposits over the $20,000 a year into an investment account where the growth is going to be tax-free. All right, so let's say this extra deposit limit is $30,000 per year. All right, so this $30,000 number is going to be based off what the cost of the insurance is on a yearly basis. All right, so in total, this individual is now putting $50,000 a year into this life insurance policy. So $20,000 is for the actual life insurance. The extra $30,000 is to have it grow tax-free. So you can take $50,000 a year and dump it within this life insurance policy. And after 20 years, you've transferred over the entire $1 million that you currently have sitting in taxable accounts into non-taxable accounts where it can get paid out to your beneficiaries tax-free, rather than if you leave it here, you're paying tax on it on a yearly basis and upon death as well. Now, the benefit with the MTAR account is if you do need access to this extra money that you're putting away, there's still ways to pull it out. So you're not locked in. All you're doing is taking, again, money that's taxable on a yearly basis that you're never going to spend anyways and putting it into accounts that are not going to be taxable to you. So if you have any more questions on this, this was an extremely high-level look at the strategy. Feel free to get in touch. Take care.